Howdy, everyone. This episode is brought to you by Fireblocks. Love this company. You'll be hearing all about them later from me later in the episode. But now, on with the show. All right, everyone, welcome back to another episode of the Weekly Roundup. Very special episode because we are joined by Mr. Tim Peterson of Cane Island. Welcome, Tim. And, of course, welcome, Mark. What's going on, fellas?
Hey. All right. Now, before we get into the good stuff, we got to do the reveal. The orange bull market pants are back, and the Bitcoin bull is back. Wow.
Now,
that doesn't mean crypto winter is over. It's still winter, and it's going to be winter for a while. But the bear market is over. Bull market's engaged. We might have another bear market before the end of winter. Don't know, but we're going to talk about that today.
Tim, did you know about Mark's sock reveal? Did you know this was coming?
I actually have socks. I didn't wear my Bitcoin socks today because they're pretty thin, and it's 20 degrees here in Texas, the coldest day of the year probably. So I'm not wearing my Bitcoin socks, but I actually do have some.
This is basically our version of Punxsutawney Phil. I'm just waiting to see what type of socks Mark has, and that's going to determine my vibe for the rest of the week, basically.
Well, 6 more. It really is going to be 6 more weeks of winter, and then springtime's going to come around. So that's a good analogy.
I love it. You know what I actually just recently learned, though? That Punxsutawney Phil is only right less than 40% of the time. So you really can't trust anyone.
It's like Wall Street analysts.
Actually, he's misinterpreted. If you look at the guys in the suits, they will tell you that Phil always gets it right, but sometimes they misinterpret his groundhog ease.
That's so good. That's so
really
good. Little jab at the Fed. I love it.
That's epic. All right, guys, we've got a really great episode today because, Mark and I have been wanting to do an episode for a long time on valuation methodologies for Bitcoin specifically. Tim, I've heard that you are the guy. We talked earlier this week. You sent over a whole bunch of great slides. So I want to get into your methodology for valuing Bitcoin, other cryptos in general. So this is always the most nerve-wracking part for me. I'm going to try to share my screen here. All right, Tim, so let's just kick it off right here. We're looking at a slide, Bitcoin valuation fundamentals. So we're looking at the price, network value, and the adoption curve, along with some annotation here. You just kind of set the scene here. What's your overall framework here, and what are we looking at with this chart?
Yeah, let me give you a little bit of my background because that'll explain how I came across this. So I'm an investment manager. I've been in institutional investment management, particularly asset management, for 30 years, ever since I graduated college. And I went and got my master's degree in finance. But all of the elective courses that I took were computer science classes, and not intro to. I took C, C++, HTML, and I had been an aerospace engineering student for a while before that. And in fact was a computer science major for about 2 semesters. So I had quite a bit of background in computer science. And in fact, one of my first jobs early in my career was as a software designer for a Fortune 500 firm where we designed cash flow models for asset-backed and mortgage-backed securities. So I had this quant background that spilled into the computer science realm, although my field and expertise is in finance and money management. So I started my own firm in 2015 and was making some investments and had heard about Bitcoin in 2013. I got it right away. I knew what Bitcoin was. I knew money was electronic. I understood how the blockchain worked. I understood queues and everything like that. But what I didn't understand was what's it worth. If I bought Bitcoin for $700 or $1,000, what am I getting in return for that? And because I couldn't answer that question, I didn't invest. That's my investment philosophy. Understand what something is worth before you buy it. And as I got more comfortable with it, I was buying small positions. But this is 2016. You couldn't really go out and buy Bitcoin in a retirement account. And a lot of my clients have IRAs or tax-sheltered vehicles. So you couldn't buy Bitcoin directly. You had to go through another vehicle like a GBTC, Grayscale. And I was looking for some diversification. I came across another firm who happened to be a former client of mine. And I was reading their shareholder letter because I was a shareholder at that time. And they were the ones that introduced me to Metcalfe's Law. And I knew these people were really smart, and they are still really smart. They operate a couple of good funds out of New York, as well as some other holding companies. And they were putting Bitcoin on some of these balance sheets well before Michael Saylor was doing it. So the first time I read about Metcalfe's Law was the first thing that made sense. And I've put 10,000 hours, literally 10,000 hours, into understanding network economics ever since 2016. What you're seeing here is the result of that work. This is about 6 years of research. Some of these papers are peer-reviewed and published. I have 3 peer-reviewed and published papers on Bitcoin pricing in different journals. So there's been some academic scrutiny put to this, and it's just one of the most impressive things I've ever seen. And the bottom line is networks have value, and that value is proportional to the number of users, and it's exponentially proportional. And that concept applies to Facebook. It applies to Bell Telephone. Recently, I found out it applies to Tesla. If you look at the number of charging stations and the Tesla revenues, Metcalfe's law works there. It works for PayPal. And the good thing about Bitcoin is there are lots of data out there on the blockchain. So if you can grab data for Bitcoin, Ethereum, Chainlink, Ripple, Litecoin, Doge, you can do this math for every single cryptocurrency, and it works like a charm. So rather than get into the details of all the math, let's just leave it at, hey, you know what? The network grows in proportion to number of users, and those growth rates line up very well over the long term. I'm going to explain some of the short-term deviations. They're not what most people think. I've put, again, a lot of research into this, and those jumps up aren't always what people think.
Yeah, and I want to add one thing here, Michael. And, Tim and I got to know each other through an organization called DAS, Digital Assets Summit. And, I came across his papers in kind of examining the same thing. So there was a guy that put together I'll call it the original Metcalfe's curve back in 2014, posted on the internet, and it was this parabolic shape. And people don't understand math, first of all, right? My math is hard, hashtag. They really don't understand exponential math, and we've talked about it, right? 20 linear steps across the room, 20 exponential steps around the world twice. And what they really don't understand is how log scale works, right? You and I, Michael, trade barbs on Twitter about chart crimes. When people show long-term charts in linear, it's just nonsense. It's not useful. You have to use log scale. And how log scale works is it's this parabolic shape, not the parabolic exponential growth curve shape that people think about when, Bitcoin's going to the moon. But this is the Metcalfe's law network effect chart. But that original model, there's variables in it, and the original model was aggressive. And Tim, through all of his research and work, and I'm going to get the lingo wrong, but whether it's the decay factor or the decay rate or whatever it is, the rate of growth of the nodes in the network matters. And so you can have a upward slope that gets you to 100,000 by 2021, which was the original chart. Then you can have the stock to flow guys who glom onto that and create another. And Tim always had this more gentle slope, which always angered the bulls. But when you dig into the math, is more elegant and I think right, which is why I've been following his stuff for so long.
Yeah, and let me just say real quick, most people aren't going to understand my papers. Okay, I wouldn't start with reading my papers because you're gonna just lose your mind.
They're not as bad as George Soros's first book, which is unreadable.
The narrative stuff in there is really good, and I think people like the narrative that explains how networks work. But in terms of the math, I have some videos on my website that are much better at showing that math in pictures and explaining what's going on. And I would start with the videos, and they're really short, and we can talk about that where those videos are at the end of the session. But you're right, Mark. There's a limit to how many users can join a network, right? It doesn't go to infinity. The transaction volume has a large role to play in that value and that the constraints, and there's several constraints. And it's not a perfect system, but models are simplifications of the real world. And if we can get to 80% of what we're trying to discover, we've pretty much got a good picture.
I have two questions for you here, Tim, before we move on to the next slide, which is one, I don't want to get too much into the nitty gritty of the math calculations here, because I agree. I don't want people to keep paying attention. But one box here that I would love to get your thoughts on is the implied value from on-chain network activity prior to exchange listing, because I think even my non-mathematical brain, I can kind of basically work out this idea in my head, which is, okay, there's some value here. As you add new participants to the network, the network becomes that much more valuable. What I have a hard time with sometimes is like what that starting value is. And then I'd love to get your thoughts here on why we see deviations around this curve that you've outlined, right? So I see here that you've got a gray box, which is Mt. Gox price manipulation. So what I'd love to understand from you is, how do we get that original implied value to kind of, this is where we start our curve. And then I'd love for you to just touch on a little bit why we might see deviations around the curve from time to time.
Yeah. So the start value actually comes out of the market. The market prices the network. Okay.
Gotcha.
And so really the pricing doesn't start until there was an exchange price, which was about 8 cents on July 18th, 2010. I have that date memorized because I use it all the time in my modeling. But the on-chain metrics go back well before that. We have user counts, transaction counts, user growth rates, the stratified sample of how many Bitcoin are in each account, and that goes back to inception. And so once you get the math formula mostly right, you can go back and say, well, what would it have been if it was trading according to those parameters? And that's what that implied value is. Now you see it drops like a rock at the very get-go. The reason was because at that point, they were putting out lots of coins, right? 50 Bitcoin every 10 minutes, starting from zero. So the inflation was huge for Bitcoin for that first 9 months. And then it starts to stabilize, and then you get this parabolic curve. And that parabolic curve in this log chart, there's legitimate math behind that. That's not hand-drawn. That is an adoption curve multiplied by Metcalfe's law, and that's that curve. I mean, it's actually a pretty simple math.
That's a really, really, really important point that I hope people watching and listening caught. Is this is not a hand-drawn technical analysis line, right? Anyone can draw lines on a chart, right? Just connecting points. That's not what this is. The core line is a mathematical formula, and there's a little chicken and the egg, to Michael's point.
It's three. It's a Gompertz curve, it's Metcalfe's law, and it's a present value formula. So unless you're an expert in all three of those things, you're not going to know how to draw that line. But you're right, Mark. It's pure math.
So let me ask you guys, why do we see some of the deviations around this curve here? I mean, I think
because
I have an idea.
Price is a liar. Price is not value, right? The price is what two people agree to exchange some small amount of a good or service. Has nothing to do with value. When people look and say, "Oh, the value of that company is X," because the number of shares times the current price, it's nonsense. I mean, it's literally nonsense. That's not value. That is the market cap. Okay? Just a thing. But Tim will talk about some of the craziness early on that led to price being worse of a liar, a big bad liar. In the early days.
Yeah, actually, I think if you go to the next slide, it's probably got a better picture we could look at in terms of those dots, right? Those four big, maybe five if you count 2019. The second one on there, the 2013, that is not just the documented price manipulation. The guy doing the manipulation was in court in Japan and said, "I did it. I was running WillyBot," right? And WillyBot was a computer program that bought and sold Bitcoin on the Mt. Gox exchange, which was the only game in town, at inflated prices. They did that so they could line their own pockets to recoup losses from a hack that had occurred earlier. And so this is not an opinion, right? When the guy says, "I was manipulating Bitcoin prices, I'm sorry," and he's telling it to the judge, it happened, okay? Now, there's been other research on this. This is just not mine. But Neil Gandal had done some great work. And at the time he published his paper was also the time that the Mt. Gox CEO admitted that he was manipulating prices in 2013. Now, that's important because when you do a price analysis or any kind of technical analysis or any kind of curve fit modeling, you got to exclude that data. That's not market supply, supply and demand working at all at that time. So you can't use 2013. So rainbow charts, any of that stuff, it doesn't apply. Okay, because that's not what happened. What happened was guys on the computer were messing around and making fake prices and inducing people to buy.
Well, and this happens every single cycle in every single asset throughout history, right? Is you have these cycles. That's why I talk about winter, right? It's not that crypto winter means always bear market. What it means is there's a cycle of time where you're correcting back toward fair value. Stocks go through winters, and what happens is early days, right? If you go back to 2012, 2013, the early days, the actual investors invest in an asset, and the investors, do the work, look at the fundamentals, try to calculate value, and buy accordingly. Then, as the price starts to move, then the speculators come in. And the speculators come in and drive that price above fair value. And if you're really unlucky, like in the stock market today or in Bitcoin back then, or again in 17, you get the leveraged speculators that come in and that's what creates that parabolic move that everybody's like, oh, we're going to the moon. No, that is manipulation. That is fake demand. And this was even worse, right? This was an egregious use of basically spoofing, which JP Morgan does all the time to gold, the other direction, and silver and everything else. But
I would just say there's a paper and it's out there. It's on my website. It's called To the Moon, A History of Bitcoin Price Manipulation. That one's not real mathy. It goes through the history of what happened at Mt. Gox. It talks about the allegations around Tether and Bitfinex in 2017. It talks about the Bitwise report in 2019 and how all the exchanges were just completely faking volume, just fraudulently putting out false volumes to induce people to trade. And it's narrative, right? So you could read it, you could understand that there's lots of funny business, and it's happening at the exchange level. Now, it's not all funny business. There's certainly FOMO, right? There's certainly people buying in, and it's not like I'm saying, hey, we weren't getting user growth at that time. We were. And there's another thing that happens with Bitcoin that we'll talk about much later. But, there's some legitimate reasons for 2017 on for those price spikes. And it's not what people think. It has nothing to do with the supply of coins. It has everything to do with the...
And it's happening now in NFTs, right? It's happening in CryptoPunks and Bored Apes. You've got people who are taking flash loans, buying their own ape from themselves using a spoof account, and that is price manipulation, and that will eventually end. But that doesn't change the nature of the growth curve of the value of the community or the network. So
I have two questions about this specific chart here that we're looking at. Is one, the estimated value of Bitcoin network per Bitcoin here. We're looking at a series of prices and dates. To my own lizard brain, is the correct way to interpret this. This is kind of a prediction about where you see a price per Bitcoin going out into the future. And then my next question is, this blue line here, it looks very intuitive, right? I mean, you can kind of see where there are these spikes either through price manipulation or through just human sentiment getting away from itself, where we kind of deviate from fair value. But it would also kind of make sense to me that in bear markets, right, after the big sell-offs, after the price manipulation or sentiment-driven rallies, that you would actually see Bitcoin trade below fair value, where it looks like, based on your chart, Tim, that the price kind of tends to settle at the fair value line. So, A, am I correctly interpreting what that blue dotted line is? And B, how should we interpret the values on the right here?
Of course, it goes below that line. Yes, it definitely goes below that line. Not very much, but it does go. And that line, where I set that line's kind of arbitrary in terms of where I want the threshold of what I call low to be, because I do use this model to trade assets, and I want to be conservative in my investing. The green line in the list of numbers, that's the low end estimate. Okay, that's saying it'll probably be. In fact, there's a statistical probability of this. There's a 90% chance it'll be higher than those numbers. Okay, wow. That's assuming assuming that Bitcoin continues to grow at the rate that it's been growing, okay? And that's not just purely an extrapolation. Now, there's headwinds, okay? We can talk about some of the headwinds, but, the government's not going to like this. They're not going to like when Bitcoin gets to 100,000, and they're sure not going to like when it gets to 1 million. And you're going to start to see some serious headwinds. And initially, they're going to start to come from the gold lobby, who's going to pressure government to do something about this stupid fake gold. Okay, because it's really going to cannibalize gold a lot more than it's going to cannibalize fiat. Yeah. But anyway, those numbers are extensions of that math. I've been publishing those numbers for 3 years, going back, and you can look. I'm not always right on the date. But I'm usually not off by more than a few months in terms of what that floor value looks like. So, like I said, those are the low end estimates based on the adoption curve.
But there's another point, Michael, that's important is you say, why doesn't it go through fair value? Like if you look at this version of the stock chart, there's one that does a regression of stock prices since 1871. And you think about it, stocks should rise, right? Why? Well, because of inflation and because of earnings growth and dividends. So stocks should rise about 6% in real terms over the long term. And so there is this same type of it's not parabolic, it's more linear. But you see big spikes above it because of FOMO. But then you're right, you see corrections down below it. And if you think about a regression, you should spend as much time above as below, just how the math works, right? If the average is 10 and you're at 5 for a long time, you got to be at 15 for a long time to make the average work. But that's a linear average. With a parabolic model, there's some subtle differences. And then there's another difference with Bitcoin. The liquid supply is relatively small versus the hodlers. And so hodlers defend fair value, so to speak, because one, many of them have done the work. Two, a whole bunch of them don't have any basis, so they're not selling. And so the people who are selling are the people who bought at the peaks. Right. And they're exhausted. They're gone when we get back down to the network value,
or they want the
so
tax
it is
loss.
This
there's a tax reason to sell those losses as well. So there is incentive to sell when it goes down.
Yeah, it's why January and March are crappy months.
Yes, that's exactly
in January, right. The Chinese are selling for Lunar New Year, and in March, Americans sell to pay their taxes.
Yeah. Guys, I just want to, for those who aren't following along on the video and listening to audio here, I just want to read a couple of these values off before we move on to the next slide. So value that I'm looking at here is by the end of 2022, you've got a price here of 55,000 per Bitcoin. By 2023, 101,000, 2024, 181,000. And then it kind of continues to go up all the way to the end of 2033, where you have a price of just under $8 million per Bitcoin. Guys, if you're following along on the audio, which is what I typically do, head over to our YouTube. You can kind of check out these slides yourself. What I like about this framework here, too, is that we've kind of got our long-term model here for the value of Bitcoin, but also in the short run, there are obviously some very different factors that drive price. So, Tim, you want to just kind of take us through what we're looking at with this chart here?
Yeah. Transactions are an important part of a network, right? And whether a network has value. And let me just give you an analogy. Let's say we've got a road system. You have a wonderful road system, and nobody drives on the road. The value of the network is zero. Okay. Now let's say you've got a road system, and everybody is on the road at the exact same time, such that nobody's going anywhere. It's not just the traffic jam. People are literally parked on the road, bumper to bumper, and nobody's going anywhere. The value of the network is zero. So at the extremes, you have zero value with nobody using it and zero value with everybody using it because it gets overloaded.
He just described Gurgaon, India, where they have 10-lane roads and literally no one on them, and Santa Monica Freeway.
Yeah, so somewhere in there is a happy middle. And I love driving on Christmas Day because you get the road all to yourself and there's only 3 cars on the road. Okay, so there is a curve there that accounts for transaction size and all of that. It's relatively minor to network size, but it does influence it. But the more you look at on-chain metrics and you see changes in transaction volume, that influences the short-term price movements quite a bit. Now, the thing with on-chain volume, so Bitcoin has this holding pen, right? When you submit a transaction, it goes into a place called the mempool, and it sits there and waits. And I want to talk about that in a later slide, but you have to incorporate those transactions, which aren't on the blockchain. You have to go out to a different source, get the size of the mempool, and incorporate that in there before you can get this light blue line here, which on a short term really tracks Bitcoin pretty well. I think the R squared on this is pretty high. It's not a perfect model. I don't care that it goes up really high and goes up really low. What I care is what's the trend. Tell me what's happening. Where is it going in relation to the long term? What's the movement in the short term? And we can granularize that with other factors later on and look at other things happening in the market.
Well, one of the things I love about, again, Tim's work and how you just this methodology for thinking about it, for, again, people who can't see the chart who are listening, you've got two lines, one blue, one black, and they make peaks and valleys along this linear uptrend, and they are highly correlated. I always joke, look, I'm not a statistics PhD, but I can tell you that the R squared between those two lines is really, really high. And what really matters when you are thinking about investing is directionality. You don't have to get the magnitude precisely correct, but if you can get the directionality right, are we in, crypto spring or crypto winter or crypto summer? Those directional trends, which you see here, do persist for 12, 18-month periods of time. That's really important.
That's the first chart, just sort of flattened out. So this sort of shows the magnitude of the peaks. How far away did Bitcoin's price deviate from that long-term adoption trend? And you can really see, you asked, does it go below zero? I could move that line up a little bit, and it would probably not really matter in terms of your overall investment performance. But yeah, it does dip below that. It's just really hard to see on the graph, and it could dip below it by 20, 30, 40%. And I'll tell you, when you take a 40% loss on your entire portfolio, it hurts. You start to question things. So it does go down below that line, and it has many times. But that line is set so that 90% of the time price is above it. That way, when I do my investing, I say, hey, you know what? I got a 90% chance of being right. And as an investment manager managing client money, that's important to me.
I will say too, I was talking to my co-founder Jason about this. It's funny, like you can. It's very easy to look at a graph like this and say, oh, in general, there's a high correlation between this mempool idea and actual price. But I mean, if you look at how long the deviations can be, it's like a year, right? I mean, sometimes these are, it looks nice on a chart, like it's definitely going to snap back, but to actually experience that deviation for a year is pretty significant. I was talking to Jason yesterday. Even when you kind of read history, you'll read like one line and it will describe like a 20-year period of time. And you're like,
yes.
Oh, I'm just waiting to get to the big thing. But it's like, that was like a 20-year period of history.
Hey,
it just gets described.
The Nikkei index hit its peak in 1984, I want to say. Mm-hmm. It has not recovered its losses from 1984. Okay, so yes, you can wait a long time, and this is true for all markets. Mm-hmm. Those alligator jaws closing, that is usually measured in months and years. And in fact, sometimes you can swear they're going to close, and it goes the other way. And there's a whole set of finance that studies why prices move away from sensible values. It's called behavioral finance. But anyway. Let's get back to the network piece of it.
One other point I want to make on the slide here is the size of the deviations to the upside, right? Because of the ability to manipulate price in the early days. I mean, you just had some unbelievable. I mean, we're talking 200%, 800% in 2013. And then it makes the 2017 bubble look like a piker, only 150% above. And then the 2021 bubble was a bubble. And people say, no, it wasn't. We never got to that blow off top of 250K. No, you're missing the point, right? It's how far away are we from this never look back price or lowest base price. And it's caused by leverage. And there's just too much leverage available. And because the liquid trading supply is so small, the hodlers aren't levering up 100 times. It's the little retail degenerate gambler, and I won't even call them investors or speculators. I mean, they're gamblers. They're literally gambling. And you guys have heard my story of someone who I won't name again because they got mad at me when I named them. But so they stole my Bitcoin. Like, what are you talking about? Like, well, I had it on this account and I had leverage and I got a margin call and they stole it. I'm like, no, you levered 100 to 1 in an 80 vol asset. You lost your Bitcoin. They didn't steal it. Now, the bad side is I heard someone say that actually is the business model of this particular firm, that they try to get people to lose their Bitcoin. So maybe it was stolen.
This episode is brought to you by Fireblocks. I talk to a lot of fast-growing crypto-native funds, crypto banks, exchanges, and the like, and they all tell me they have the same two problems. One, their treasury management setup sucks. They've got analysts wasting time and money on manual transactions. Two, they are not happy with their current security setup. They're sharing passwords, they're sending test transactions, and they're worried that their funds might be at risk. Fireblocks is a platform that solves all of that for you. They are a one-stop shop portal which automatically plugs into exchanges, trading venues, etc. They source deep liquidity and solve everything from day-to-day crypto transactions all the way down to complex DeFi strategy. And the best thing about Fireblocks is that they offer scalable solutions with industry-leading technology. Doesn't matter if you're a 2-person crypto fund or a 2,000-person crypto exchange, these guys have you covered. And the last thing that I'll say about this company is that I have known them for years. They are a high-integrity team. They ship product like no other. I would trust them with my own funds. So, click the link at the bottom of this page and tell them that I sent you. Very, very important that you click the link at the bottom here. Otherwise, they're not going to know that I sent you, and then how am I going to get credit? So help a brother out. Click the link at the bottom of this episode. Tell them I sent you. So walk me through the difference here, because we're seeing price deviations, right? Tim, is this what we're looking at here, the deviation between mempool activity and price? And then here we've also got hash rate and price, because it looks like slightly similar but slightly different charts.
They're similar and different. So the question is, what's the size of the network? I want to measure value to some fundamental metric, and how do I measure size? So you have to just pick. You can pick many, right? You can look at number of zero accounts. You can look at active accounts. You can look at transactions. Anything that describes network size is going to give you some picture of relative value. And the reason I've done these two is just to show you they can produce similar results, but not identical. That's true in the stock market, right? You can look at price to earnings, price to sales, price to to EBITDA, whatever you want to look at. And you from that you get a picture. Are we too high or too low or somewhere in the middle? And right now this says, hey, we're a little bit too high. Okay, we're a little bit above the adoption curve in terms of hash rate. We're above the trended hash rate. That doesn't mean it's gonna go down, but it wants to go down. I like to say there's downward pressure on it, and that's all this does is just show you different ways of measuring network size. This one you've got up here is user growth rate, and user growth rate's a great measure to look at. So Bitcoin's price has to move in tandem with its user growth rate, right? Yep. Those things have to move together. And this chart just shows that they do. And in fact, that user growth rate, it declines, and it declines years in advance of when Bitcoin starts to hit a crypto winter or a crypto fall. Does it always correct? Mostly. I mean, if you like 4-year cycles, this is a graph that should make you happy. Look, there's a 4-year cycle here. It goes from 13 to 16, then from 17 to 20, and it hits zero at the same time, like clockwork. But the point is not when does it hit and when's it bottom out. The point is there's a relationship here, and there's a meaningful relationship, and these two things have to run together. So if you look at our network addresses growing quickly, or are they growing slowly, or are they declining, that should give you some indication of where Bitcoin's price is headed.
Yeah, and one interesting metric that I would overlay onto this that might not, a little inside baseball from someone who has got some statistics on media. I personally think that retail left the market a lot sooner than people think. I think retail activity actually kind of peaked around February of March of 2021, and I think it's almost been, even though we had that.
You see it in the chart right there. Absolutely, that happened.
I mean, it's just funny because some audience metrics kind of line up with what you're seeing here, just in terms of user growth, right? Non-zero addresses.
Yeah,
so
you'll see it in some other economic metrics we've got too. That whole consumer.
You got Google searches, you got podcast listens, downloads. There's so many great indicators. But again, what I love about that chart is people who look at it and say, "Oh, okay, great correlation, great information content. Oh my gosh, it's going down." Well, of course it's going down. Okay, it's the law of large numbers. It is hard to grow a large network. Look at Apple, right? Apple's growth is down close to zero. Think about that. Their net earnings last year were roughly the same as 15, 16. Now their earnings per share went up a lot because they bought back more stock in the last, I don't know, 3 or 5 years, but whatever, more stock than the market cap of 491 companies in the S&P 500. Just let that sink in. So they artificially manipulated the appearance of growth by manipulating the share count, and yet they aren't growing. And that's because everyone that has a cell phone, I mean, I have 2. I'm not getting a third. I don't have 3 hands. So that's it. And it's just harder to grow a monster network. And Bitcoin's growth rate is going to continue to trend down, but the size of the network is going to trend up in an exponential way, which means the value will rise in an exponential fashion.
That's right, Mark. Let's look at the next one, Michael. This has become my favorite chart. I just discovered this past week because Bloomberg put out a chart of the negative yielding bonds. This is the Bloomberg negative yielding debt index, and it goes up and down and up and down. And the point they're making is, hey, negative yielding debt has dropped to a level where it was in 2018. And so that your listeners understand what negative yielding debt is. Negative yielding debt is like putting the money in the bank, and instead of earning interest, you pay interest. So you put your money in the bank, and then you put more money in the bank, and you put more money in the bank, but you don't get that money out. You only get your original investment out. So you pay them to store your money, and you lose money. Okay, that's a negative yielding bond in a nutshell. And some people need positive yields. Elderly people that are on a fixed income need positive yield. Any institution that's doing asset liability needs a positive yield for their duration management. So insurance companies, which are a huge segment of the financial sector, need positive yields. If they can't get it in the market, then a portion of those investors, a small portion, are going to look elsewhere. And some of those investors are going to choose Bitcoin. Maybe not in totality, but a portion of their assets will go to Bitcoin. And you can see that literally in this chart. This is the negative yielding debt volume, the balance going up and down. And the blue line is the size of the number of transactions waiting to be processed in the mempool. So it's not the total transactions, but this is the backlog of transactions waiting to be processed. So I want you to imagine you're going to go to a football game, okay? Normally, if it's just a boring football game like any old day, you can get a ticket, you can walk in, there's plenty of seats, you can enjoy the game. But if it's the really big game, right, that everyone wants to get in, I want you to imagine that there's only one entrance to the stadium. Everyone must go through that entrance. You can only buy the tickets on that day. It is first come, first served. The tickets go to the highest bidder, and you have to pay a fee to the person who's processing the ticket. Okay, what happens when it's the playoffs and the Super Bowl and everyone wants to get in? You would have a huge line of people outside the stadium clamoring to get in, throwing money, saying, give me a ticket, give me a ticket. That's the way Bitcoin works. There's a limited number of transactions that can be processed in a day. It's roughly 300,000 because it takes 10 minutes to process a block on average, which is about 2,500 transactions. And so there's this group of transactions that are sitting waiting to be processed. And if you want yours picked, you have to offer a higher fee, all the while the price is going up. And that's what this picture is. That blue line is people waiting outside the gate, clamoring to get in. Let me in. I want to buy Bitcoin. And it really corresponds very closely to negative yielding bonds. Now, it's not that negative yielding bonds is driving this. That index is characteristic of what is going on in the macro environment.
Yeah, it's the level of financial repression in the world. And when financial repression is very high, the need to seek better yields, whether that be converting fiat into Bitcoin and then borrowing against it at one of these lenders, any of those things. And it's one of my favorite lines, the joke about the restaurant, from Yogi Berra. No one goes there anymore. It's too crowded.
Yeah. And so you can see this translate into price on the next slide. It doesn't work perfectly, but this is not just FOMO, and it's not just leverage, and it's not just manipulation. This is fundamentals. This is pure fundamentals. And you can see in 2019 that Bitcoin price bubble corresponded almost perfectly to the negative yielding debt index. In early 2021, you get that first little hump almost perfectly to the negative yielding debt index. In fact, if you study this graph, you'll see other little ups and downs in those prices that are very closely related. They're highly correlated. It's not a perfect match, but again, we're just trying to get a picture of what's going on in the economy and how does that affect Bitcoin, and you can see it in both those charts.
Well, and the beauty of this chart is you see the impact of leverage. And so the gray line, which is the amount of negative yielding debt, leads the red line, which is the price spike of Bitcoin. And then you get this total parabolic move at the end of 2020 into 21. And that was people borrowing. Because again, if interest rates are really, really low, if there's lots of negative yielding debt, then people can borrow huge amounts of money and buy an asset that they don't have. That they don't have money for.
Particularly in Asia, where you've got 200 to 1 leverage available. Yeah. And that came out. I believe Binance started that program in early 2020, if I'm not mistaken.
I think you're exactly right. And that was the big move that everyone says it was Saylor. Well, he may have catalyzed some interest, but it was the Binance or Binance, however you pronounce it, investors, speculators, gamblers. They're not investors. They're gamblers.
Binance has to be a trend now. You know how people in finance and finance, Binance and Binance. That's like with a little bit of sparkly, a little pinky.
Well, it depends. It depends where you are, right? When I talk to people in Singapore and Hong Kong, they say Binance. When I talk, and it's like down here
really
in the South, right? They say insurance. I'm like, what? No, insurance. No, like, insurance. I'm like, no.
Yeah. My best friend is an English guy, and he always says aluminium, which always cracks me up. Yeah.
It does make you sound really smart if you can actually pronounce it that way.
English people in general have a huge leg up because they just sound smarter in general. I always tell him he's playing tennis with the net down. All right, so we're looking here at, Tim, why don't you just tell us what we're looking at here?
Yeah, so the past slide was about negative yielding debt, and so that's an evaluation approach that's sort of like Bitcoin's digital gold, and it's an alternative safe asset. So it would be like the Mike Saylor approach to valuation and why it would be trading that way. But then there's this whole other group of investors, and it's actually quite large, who think that Bitcoin is just a tech stock, right? They don't know how to value it at all, and so they will just trade it like any other tech equity. And this is the Nasdaq 2 times leveraged ETF, and then it's also overlaid with Bitcoin, and you can see that trend. Again, it matches up kind of well, but what I look at is the smaller bumps, like the bump in late 2021 and the bump in early 2020. Those line up really well. And what happens here is you have a pool of investors who, first of all, professional investment managers are not trying to buy low, sell high. That is absolutely not what they do. They don't care about price action one bit. Their job is to manage risk. So when circumstances change, and what they will think of is, I need to shed some risk out of my portfolio. And they will typically do that across the board. They will reduce a lot of their positions in proportion. Okay,
Got
not
it.
always, but so typically what you see is they'll say it's too risky. I need to shed some risk. They'll sell Bitcoin along with selling everything else that they consider risky, and that moves Bitcoin's price. It does have an impact on the price.
This is the greatest chart I've ever seen. We're only talking about 4 years because there's only 4 years of like real activity in this space where there were charts. But it is the greatest chart I have ever seen. And I thought I'd seen everything Tim did, but I haven't seen this chart. This chart is so great for the following reasons. People say, oh, the correlation of Bitcoin is going up because people think it's a stock. The long term, and that's the only correlation number that matters. The long-term correlation number is still 0.15 to stocks. However, in periods of time where leverage is expanding or contracting, correlations, particularly when leverage is contracting, do go higher, close to 1. And the genius of this chart is using the levered ETF. Because the levered ETF has that same level of volatility. Nasdaq volatility only in the 20s, right? Bitcoin has an 80 vol. You need a better vol asset, and leverage, because leverage is what's driving the vol, is perfect. So this is absolute genius, Tim.
Yeah, it also matches up pretty well with the Nikkei index for some reason. And it only matches up in short time periods.
Global carry trade.
Yes.
Because that's the global carry trade right there.
Plus, I think the name Satoshi Nakamoto has an impact on the Japanese. They're big fans of Bitcoin for that reason. So anyway, that's a picture of where we're at with Bitcoin's valuation. The total assessment, if you look at all those pictures, is that we're trending down, but we're either at bottom or we'll get to bottom very quickly. And I think we're probably price bottom 60 days. Now, I'm not saying that because I want people to go out and trade. I'm just saying this is not guesswork, right? This isn't about, stick
We're
my
going to
thumb in
test
your-
30 again,
Yeah.
more likely than not. But that is where the base level of value is. And then, 6 months from now, we'll look back and say, oh, geez, what a great buying opportunity that was.
One other thing too, just an observation from a company building standpoint as well is this is a non-scientific framework, but it's a framework that I do have in my mind, which is that, whenever a market gets overheated, there needs to be some stamping out of sentiment in general before you can start to move back up. And one of the ways that I justify that, or that I think about that internally, is that it's very hard to company build in environments where where speculation is running rampant and everyone thinks they can become a millionaire just from flipping Bitcoin or JPEGs. It's really, really difficult. And I think sentiment peaked at different times of the crypto market in general. I think you can really clearly point to the laser eyes and Bitcoin Miami F Elon, that chant, right? That was like so clearly the sentiment top in Bitcoin. It came later for other parts of the crypto market in general. And I think NFTs have to be the last thing to capitulate in general before we can all just kind of sit down and say, all right, now let's actually try to solve problems again. Because from a labor standpoint, it's really difficult to find people who actually want to build things instead of just speculate.
Didn't you go to the
insane
Portugal Solana party?
I did.
So there you go. Anytime there are massive parties, like let's just set a rule. If someone spends more than $500,000 on a party, bad things are going to happen in that market.
Well, the number one question that I got asked at that party was, don't you believe in the super cycle? And for me, I was just like, the ironic thing is I think we are living through the super cycle right now. Suzu's point when he coined that term was just that it's unrealistic that we move in 4-year boom bust patterns into eternity, right? That was his only point. Now, people chose to interpret that, it's kind of branded, and it was going to be up only forever. But I don't think that was the original point that's being made. I think we're actually ironically living through it. But I want to talk about Ethereum as well here, because I want to make the connection between this other chart here, which is looking at Bitcoin versus the Nasdaq, right? And people don't really understand how to value Bitcoin, so they're kind of just saying, this is going to trade like a risky tech stock. Ethereum is interesting in that I kind of feel like I have started to talk to investors and they're like, Ethereum equals FANG, So Tim, can you just kind of walk me through, how appropriate is it to use the valuation metrics that you have for Bitcoin and methodology that you have for Bitcoin to another asset like Ethereum, and then maybe how are investors looking differently at Ethereum than Bitcoin?
Okay, so the underlying principle of Metcalfe's law, network size, applies to every single cryptocurrency that is not a stablecoin. You've got to get quite a bit of price history in order to get confidence and get some metrics around there to properly estimate where that curve is. Because like Mark said, the price is a liar. The value is not. And you do need a track record in order to properly value it. The thing with Ethereum is that people don't know how to value cryptocurrency, so they just do whatever Bitcoin does. And they'll say, well, Ethereum's a little bit more risky than Bitcoin because it's smaller and it has less of a track record. So they'll assign a beta to it of something like 20% or 40%, and you get additional volatility in Ethereum. But otherwise, it's mostly tracking Bitcoin. So the correlation to Bitcoin is very high. But if you take that away, and I'm writing a paper on this right now, it should be out in the next couple of weeks. Ethereum has its own metrics, and Ethereum's price, adjusted for Bitcoin, tracks its own underlying metrics. There's an adoption rate, there's transaction activity that affects the price, and that's what this chart says. The reason I put this up here is because you can see that green line, that's the long-term adoption trend, and I posted this on Twitter about a year ago, and you can see the price wants to hug that trend. That's where it wants to go, and they'll look at the next slide. It'll show you what Ethereum actually did. It moves right along, right towards that green line. So that green line, I look at the adoption curve as like gravity, right? You can escape gravity. You can go up and you can get on a balloon. You can stay up there for a long time. But eventually you got to come back down to Earth. And that green line is Earth. So we're headed towards the green line. That green line goes up every day. The adoption continues to grow every single day. So it's not like the price has to fall. It could just go sideways for a while, and you can get there.
So guys, if you're not following along on video, what we're looking at here is a tweet that Tim put out on February 4th of 2021, essentially predicting the direction of Ethereum's price, and we're looking at the current day price, where it's basically followed the red arrow. I really like that metaphor of gravity around the green line. Guys, we're running low on time here. I want to ask you actually a question that I'm starting to ask myself quite a bit. Big narrative, right, for 2021 in general was the layer one wars, right? And are we going to live in a multi-chain world? Is everything going to be built on ETH layer 2 as we scale, et cetera, et cetera? Now, if we're looking at history as a precedent here, generally in Metcalfe's law type environments, one big network wins, right? That's why we have network effects. And you can look at Facebook, Meta's earnings yesterday notwithstanding, they really just dominated, right? There is no really second best Facebook. They really just took the cake. So if the way to value all of these protocols is based on the network effect, then are we going to see one or two really dominant winners and the vast majority of these other networks become less valuable? Because you kind of have this narrative, which is
not one or two. So the answer is yes, but not one or two. And I've used this analogy many times, and I've yet to find anybody kind of tell me that I'm wrong. Is there were 80 internet protocols, now there are 5, right? There's TCP/IP, there's FTP, HTTP, SMTP, and www. Maybe there's one or two others, but that's pretty much it. And I think the same thing's going to happen here. And you're going to have, Bitcoin is the base layer. You're going to have Filecoin like FTP for files. You got Ethereum as the www. And then you're going to duke it out in the middle for HTTP and SMTP. And could it be 2? Could it be 4? I don't know. But yeah, of the thousands of utility tokens, those don't follow network effects. Those are simply Ponzi schemes, most of them. Some actually have innovation or tech, and those will be huge. They'll be 100-baggers. But that's a different game, right? That's a venture capital game. It's basically crowdsourced venture capital with scammers involved. That's the other, of course, venture capital has scammers too. Look at the one that just got with the black turtleneck.
Yeah, I'm starting to think that Bitcoin is not part of the cryptocurrency ecosystem anymore. There's a law called Zipf's law that describes the distribution of who has market share, right? Number one, and it describes it perfectly for all assets and all types of things. If you look at number of astronauts ranked by what university they came out of, it follows Zipf's law. It's just pervasive. Bitcoin doesn't follow Zipf's law when you look at it compared to other cryptos, but it does when you look at it compared to other assets like commodities, equities, bonds, etc. So I think Bitcoin has left that ecosystem and is in the alternative investment ecosystem, which means the top of the heap is Ethereum. And those coins do follow Zipf's law for the most part. Now, it depends on what day you're looking at it. But like I agree with Mark, it's not one or two, but you'll look at how many soda pop manufacturers there are. How many are there versus how many can you name? How many beer brands are there? But how many could you name? There are things that get used and get used widely, and it's a number that's pretty small. And the rest are are sort of the hobbyists that will stick around. So there's going to be a lot of
all technologies. This is true of all technologies, right? When the car was new tech, right? At the turn of the century, there were 300 U.S. automakers. The largest, I love this, was American Electric Vehicle Corp, right? So electric cars are more than 100 years old. And it was put out of business by Standard Oil and Henry Ford because they wanted people to buy gasoline and run on his cars. So, look, there are 300 today that you can name 3 or 4. That's it.
Yeah,
that's the nature of tech.
Yeah, and the thing with networks is if you're not in the network, you have a huge disadvantage. What do we do to punish children today? We don't turn off the TV. We take away their phone. You get put out of the network. That's a punishment. Okay, and it has horrible consequences because if you're not connected, imagine if we punished a city that we didn't like and said you're not going to transact with any other city. Right? Well, that's siege warfare. Okay,
that's coming. That's coming to CBDCs.
Yeah,
that's coming.
So when you are not in the network, you're not getting any of the benefits. And that network's growing exponentially, and you're growing at 0. So you can either join the network or you can die. And we saw this with Microsoft Office suites, right? It was Apple had their version. Microsoft built one that ran on Apple, and then one built that on IBM, and they didn't talk to each other, right? In the 90s, it was this horrible, painful process of doing a conversion. When those got integrated, now you've got lock-in. And Lotus 123, who remembers Lotus 123, the spreadsheet? It died, right? WordStar and some of those old word processing programs, they died. There's one Adobe, there's one Microsoft, there's one Amazon. If you're not in that network,
monopoly.
But,
they're monopolies.
And that's what happens. Networks create monopolies, and this happened with Bell Telephone. It was the only game in town in the United States for nearly 100 years, and it got to be too big and powerful, and Congress said, we have to break you up. That was a 13-year process. What's happening now? Google, Facebook, you guys are too big. You're a monopoly, and you're crowding out competition, and you're doing some harmful things. We have to break you up. That breakup process takes a long time, and it's really hard to do. Yeah. But and I'm not sure they can do it this time around. But we'll see. But yeah, there's some definitely harmful effects that come from large successful networks.
That's like you don't hear that view espoused a lot in crypto. And I wonder if, there is this idea, sometimes it's a little frustrating to me, where everyone has to be supportive of everyone and yada, yada. And I feel like this is a view that is underrepresented on podcasts and public speaking because we want to say, hey, we live in, go to this multi-chain world and everyone can succeed. And I feel like maybe that actually isn't the case. And that doesn't have to be a bad thing. And, one dynamic that might be changing.
It's not.
Yeah, I mean, one dynamic that might be changing overall, I don't know if you guys subscribe to this idea, but, Bitcoin is the only thing, in my opinion, in crypto that is a true money. And an investment in money is very different than an investment in tech, I would say. So as maybe Bitcoin is kind of going off into its own, own kind of land, and then the rest of crypto looks a lot more like tech investing. And in tech investing, there's disruption. And, MySpace was the first. They had it all right. They were totally right, but they got scooped by Facebook.
So did
maybe
BlackBerry.
The dynamics are changing.
BlackBerry had that market share. Motorola phones had that market share, and they do get upset. You're absolutely right, Michael.
Yeah, guys, we did the thing that I said I didn't want to do. We didn't get to our stories, but you know what? This was
We'll just
great.
do lightning round. Just do lightning round
All
on
right,
the two
lightning
stories.
round. Okay, lightning round, guys. So the two stories that I want to get to are Meta's earnings miss. This one's just interesting because obviously a colossal amount of volatility, right? After hours trading, Meta shares dropped by like 25%. It was a relatively minor miss, but they had some guidance, I think, that was worrying to investors. Do you guys have any opinions on Meta's earnings yesterday?
Apple basically realizing that we can't grow and this other company found this way to make money off our data, so we're not going to let them. We're going to do that. That's my view.
Well, I'll say I was surprised at the volatility. I'm not surprised that Facebook is leveling off in terms of their growth rate. I think it's a good thing that they lost users. Not because I hate Facebook. I'm not on Facebook, but it demonstrates that users drive price. That's what I've been saying all along. Users drive price. Facebook reports a decline in users for the first time in its history, and look what happens. And that price change, that's a proportion. So if you lost 10% of the users, you'd lose 20% of your value. And that doesn't always get reflected in price, but I'm not surprised that it happened.
Yeah, I mean, the big thing is they weren't the first. Netflix was first. They got lambasted, same amount, 20-something percent, because their growth rate slowed. Part of the problem is because of financial repression, people piled into these same 7 stocks, the Fangman stocks, and they bid them up to prices that make no sense, right? Companies that are growing low single digits that you're paying 30, 40, 50, 80, 100 times earnings for just didn't make any sense. So the downside volatility, when gravity hits, gravity is a bitch.
Yeah. Guys, the next thing that I want to get to here is the Bank of England. So the Bank of England is talking about worried about an inflationary spiral, right? So they see inflation peaking over in the UK in April at just over 7% CPI inflation, and they are talking about hiking rates more aggressively, perhaps a 50 basis point hike. What do you guys think of just the posturing of the Bank of England in general, and this kind of extreme language that they used in terms of an inflationary spiral?
Nonsense. Right? It's all nonsense. It's Jerome the Hawk pretending that he's going to come back and raise rates. Jamie Dimon saying 7 rate hikes. It's all bullshit. It is to get people to think that's the worst case, and then you surprise. It's overpromise and underdeliver. Take the under on rate hikes. Inflation is totally transitory. It's 100%. The difference between the 2% base rate and the 7 is oil and used car prices. Those are transitory. Oil's not going to double again from here. It's just not. And so I think it's just nonsense posturing. And Carney, look, he's an ex-Goldman guy. They're all ex-Goldman people. I mean, they are all in the bank's back pocket. This is all about justifying emergency low interest rates to make the bankers super rich.
I mostly agree with that. There's a difference between what banks want to do and what they can do. They could not raise rates to the level that they want to because demographically it's just not going to be supported. And there's nothing else they can do at this point. And I think you're going to see some. Actually, I think the next 10 years are going to be hard because the banking sector is going to start to see, hey, we're starting to see things slip away. You're already seeing it with the inflation, right? But other elements of their historical economic hegemony are going to start to slip away from them, and that's going to be frightening for them, and it could be frightening for us too because what they do has consequences on your life. It'll be interesting to see, but I'm not overly concerned about out of control inflation or out of control interest rate hikes.
Yeah, Rothschild Inc. isn't going to go down without fight. Rothschild Inc. has been around for hundreds of years. They ain't going away without a fight.
Long time. Well, in case we need any other directional indicators, I don't know if you guys saw the cover of The Economist, but it was will rate hikes continue into perpetuity? Are rate hikes are interest rates going to go much higher? So
Economist cover curse.
Yeah, we've got our
Economist cover curse.
All we need is a Kramer tweet, and it's basically set in stone that that they're all going to do a big pivot. The last thing I would say that's really interesting, there's a guy named Russell Clark who's come on the show before. Mark, you and I have talked about him.
He's the
really,
best.
really good. He totally changed my viewpoint on inflation with this one line. There was a podcast that we did with him and Tyler Neville like 7 months ago. And he said, if you stop thinking about inflation as this big bad boogeyman and start thinking about it as blue collar wages, then you start to think about it very differently. And I was like, wow, that actually is a really interesting way to think about it. And one other way to frame central banks being very concerned about inflation is it's like for the first time in a long time, blue collar workers in developed nations are getting a pay rise. And we're all like, whoa, unacceptable. I'm not saying that's 100% accurate, but it is. For me, it was just a different way of looking at it.
But they didn't get a pay raise. They got an income raise, but their costs went up way more. Mm-hmm. That's theft. That's why the creation of inflation is theft from the blue collar to the elite, 1, and now it's 0.1%. It's just it's a kleptocracy. It's always been a kleptocracy, and it's horrific for the average person. So.
Well, guys, look, I know we've got to wrap up here. Mark, this is, again, favorite hour of my week. Tim, thank you so much for coming on. This was the reason why this was we should have framed this at the beginning. The reason why this was an important one to do is even, 12 years into Bitcoin's existence, I think a huge impediment to getting people involved is I have no way to value this. So hopefully, folks, this gave you a framework for some actual methodology for valuing Bitcoin, Ethereum, and other crypto assets out there. So
this is going to break the internet. It's going to break the internet. We're going to break the download record. We're going to crush those other, we don't comedians.
Even need to say their name. Yeah, those other comedians.
Yeah, we won't say their names. The other jokers. It's just going to crush them.
Let me plug my website because there's some good
do.
stuff on there.
Please do.
It's caneisland.digital. That's CANE-island.digital. And go to the videos. Watch the videos first. Don't do anything else. Go to the videos. If you like what you see, you can explore there. Most of my work is free. It's completely transparent. I only sell one product, and that is a price forecast that goes out 2 years along with commentary, and that will be for sale within the next 30 days. But everything else is free to use.
Tim, we'll do you one better, and we'll just link your website right in the show notes. And folks who are listening, be sure to head over. A lot of great information over there. Gentlemen, this has been a ton of fun. We'll have to do it again sometime soon.
Best hour of the week.
Hey, thanks
so
Michael.
Much, guys. Thanks, Tim.
Thank you.
Cheers, guys.